Hey guys, Robert Lunt here with Realty One Group Skyline, and today I want to go over what it takes to qualify for a loan as far as what lenders look at to what you make, what your expenses are, and what you can afford when it comes to getting pre-approved for a home loan, guys. Whether it's new construction, pre-owned, just keep in mind, new construction, guys, you're gonna have lower insurance, right? So that's what I mean by monthly payment. It's gonna be your principal, interest, taxes, insurance, guys. Those are the things that are built into your monthly payment, and that could be your CDD is in there if it's a CDD community, guys. And then one thing you have to consider, guys, is if you're looking at pre-owned houses in areas of, say, Florida, where I practice real estate, guys, where I'm a licensed agent and I help people all over the state do real estate transactions. In Florida, with all the storms that we've had, and stay tuned, guys, I'm gonna do a video on hurricanes, so look for that, on how safe certain areas are, especially Parish, Florida, guys. That's where I specialize, that's where I base out of. So we're gonna go over the Parish, Florida history with hurricanes and how safe it is to buy a home and how safe Parish may or may not be. So look for that video, guys. But in the state of Florida, we've had some storms like last year, 2 years ago, that wiped out a lot of homes in a lot of areas, and it cost a lot of insurance companies money to mitigate all that damage. And what has happened now is you're seeing a huge spike in insurance. So on older homes, especially homes that are in those hot zones and flood zones, they have high insurance. It could be like $2,500 a year for hazard insurance, $2,000 a year on an older home that's, say, a 3-bedroom, 2-bath, 1,300 square feet, when you can go get a 2,000 square foot home, 4-bedroom, 2-bath in a new construction neighborhood, say like in Parish, Florida, where I specialize in, and your insurance is only gonna be around $1,200 a year. So there's pros and cons to that, guys. Yes, you may be able to find one without an HOA, without a CDD, but it may have higher insurance, and then you're gonna have maybe immediate expenses for repairs and upgrades that you want to do to the home when you buy a pre-owned home that is already there, that you're kind of used, and it may not be 100% up to par, guys, and it may need some stuff. You never know when you move in. Your home inspection may come in great. I have no problem selling pre-owned homes. I do it all over the state. I've got stuff pending in Punta Gorda. I've got stuff pending in Sarasota. I do deals in Plant City, Anna Maria Island, Gainesville. It doesn't matter, guys. Kissimmee, you name it. I'm with Realty One Group Skyline, and like I said, I have a lot of experience. I've done hundreds of real estate transactions. I've been in the business almost 10 years, and I get a lot of first-time home buyers asking me these questions. So I wanted to educate you today on what the lenders are going to look for, especially when trying to qualify you for your first home loan, or if you've bought a home a long time ago, or you just have no idea how the process works, guys. We're gonna go over some math here in just a second, and I'm gonna show you exactly what lenders are looking for to pre-approve you. And this is some of the things that you may have seen on like a loan application, right? When they're asking you for your expenses, and they're gonna be looking at your credit report. They're gonna be asking you what your assets are, what your liabilities are, what your monthly expenses are, your fixed expenses, guys, especially the ones that affect your credit report and your credit score. Now, credit score is a big factor as well. You want to have at least a 580 for FHA in the state of Florida, guys. That's the minimum. And then once you get over that 720, that's when you really get those really good interest rates, guys, and you get those, it's cheaper to buy down the rate and stuff like that, guys. And then if you have, say, stuff like 20% down, then you can get a loan where it doesn't involve mortgage insurance. Mortgage insurance is something that they put on the loans in case you know, there's a risk of the loan not getting paid, so it covers those payments while they're in the foreclosure process, you know, trying to repossess the home from someone who is not paying. Is that mortgage insurance, guys. So, and if you have 20% down, then you can eliminate the mortgage insurance, guys. So let's do some math. I hope this video serves you well, and I hope it's very helpful if you're a first-time home buyer or just looking to relocate to Florida, guys, or you already live here. I'm a listing specialist. I do listings all over the state. I've been in business for 8 years as a licensed agent, 10 years as an investor. I've done over 35 flips. I own several rental properties, and I've done hundreds and hundreds of transactions, guys, as representing clients as their real estate agent, guys. You can Google me, Robert Lunt. Go on robertlunt.com, check out my reviews, guys. Check out my YouTube channel, hit the like, hit the subscribe, and I hope you really enjoy this video and get a lot of value out of it. Thank you. Let's check it out. Let's go to the numbers and see what they're looking at. Check it out. Now, lastly, guys, I also wanted to make clear is that if you're an investor buying an investment property and you're unexperienced with that as well, they're gonna take a lot of times, especially if you can get a commercial loan. I've done this in Indiana where I've taken 4 separate addresses, combined them into a commercial loan, and then it was based off of the property's income, not my own income. So they based it off the performance of the property, off the assets, what the rents were, minus expenses, right? They look at me a little bit, and sometimes they want a personal guarantee, sometimes not, guys. It just depends on how much of a down payment you have, how much of a loan you're looking for, guys. So these are things to keep in mind if you're an investor looking for an investment property as well, guys. I can help you. If you have any questions on that, like I said, give me a call, guys. All right, I hope that helps. All right, guys, so working with builders, we've had to pre-qualify people on all the different communities that I work in. Some we pre-qualify right up front to see what homes that they can't afford. And this is the exercise I use if I'm trying to help you figure out what you can afford. Now remember, guys, I give you a rebate to help you with your closing costs and extra incentives. You know, if they give me a bonus, I help you. So this could help you close on your home if you're tight on funds. Call me if you want to know more about that. And it depends on which builder too, because some builders, they don't really pay a commission. Most of them do, but there's 1 or 2 that don't. So I can't really offer, you know, like a $2,000 rebate to from a builder who's only paying me $2,000. But so guys, this is how they're gonna calculate what you can afford on a monthly payment, and it might help you because it makes sense, right? Like it's gonna tell you what can I afford if you're trying to figure out a budget. So let's just say you're making $65,000 a year and you're a single person. Now, if you are married, they're gonna take the 2 incomes together. If you're married, it's a household income. That's how they work it. But if you're not married, it's whoever's going on the loan. But if just one person's going on the loan and you're married, they're gonna use both incomes. So let's just say we have an income of $65,000, guys, and then they're gonna take 50% of that. So 50%, because they use, you know, they figure the other money you need to live, for food, for gas, for fun, for whatever, for emergencies come up. So they're gonna take half of your gross annual income, right? And then that's gonna be $32,500. So, and then they're gonna divide that to get your monthly by 12. So we're gonna divide the 65 by 2 to get you to 32,500. And then we're gonna take 32,500, divide that by 12, gives me 2708. So that's 2708 a month, okay? And then they're gonna subtract your fixed expenses off of that. And by fixed, I mean credit cards, car payments, personal loans. Everything else is variable, it could change, it's negotiable. It does not affect your credit, but the things that get reported on your credit, all of those loans that you see on your credit report, those are gonna be the ones, those minimum payments. So let's say you have a car payment. Don't include your car insurance now, because that doesn't report to your credit. So just your car payment. So say you have a car payment of $450 car, right? And then you have, say, 3 credit cards, $40 minimum payment on each of those. That's gonna be $120. So minus 120 credit card. And then we're gonna sum that, take the sum of those, the 2708 minus 450 minus 120 equals 2138. So 2138 would be the monthly payment, and that's with your taxes, insurance, principal, interest. That is everything, guys. So that's your PITI. Principal, interest, taxes, insurance. They don't count the HOA, but your CDD, if there's a CDD, it will be in there. It's in that payment. So 2138 all in, guys. So obviously, you know, in a medium home price in this area in, say, Parrish, Florida, right, on a new construction home, around 400,000. Between 400 and 450,000, you know, with a minimum down payment at a 7% interest rate, unless the builder is giving you incentives to buy down the rate on top of the incentives that I give you guys. Remember, contact me at 941-879-4730 if you need a great real estate agent. And I do all services, guys. I'm a full service real estate agent. I specialize in new construction and listings, and I'm very investor friendly. I do a lot for investors. I am an investor, so I know my numbers. I've done hundreds of transactions, guys. I've done 35 flips. I own many. I've been doing this for 10 years now. So I've been working with numbers my whole life, guys. Auto loans, real estate loans. Now I'm not a loan officer, guys. So sometimes speaking with a loan officer who's a little bit more creative, and they may have lenders that aren't like FHA or conventional or something like that. They have different types of loans that they can get you that may skew these numbers a little bit, but for general loan purposes, like the big lenders that only have, say, FHA, conventional, VA, this is the equation that they're going to use to pre-qualify you guys. So, you know, like I said, medium home price right now, say 400 to 450,000 with the minimum down payment, say 3.5%, or if you qualify for USDA, which has an income cap, but this income would qualify. That would be 0 down. Now, when you're buying down the interest rate, you got to think about that, guys. You can buy down the rate further with less money with an FHA loan versus USDA in the state of Florida. So these are things to consider, guys. This is why it's not all set in stone. It's good to have someone who has experience with this, and we can try different things to see what's going to work best for you. But based off my experience, I can give you a great idea up front of what you can afford, and I can ask the right questions and point you in the right direction, because I know what builders have the rate buy downs. I know who has the big incentives. I know who's selling in this price range and that price range when it comes to this area, guys. So, you know, on average on a $400,000 to $450,000 home with a minimum down payment, you're gonna be over $3,000 a month, right? So over 3,000 plus. So you're not going to be able to get much. You know, you're going to have to go for like even a townhouse. You're going to need a large down payment. So that's just the monthly payment. So you got to think like, okay, how much money do I have to put down to get to 2138? if that's all I can qualify for. And that's where you're at, guys. So, or how much do I have to buy down the interest rate? Because every, say, $1,000 in loan amount is going to translate to about $5-6 a month, guys. So based on that, $100,000 is $500 to $600 a month, depending on the interest rate, on average, roughly. Now, if you were to buy down an interest rate, say at $450,000, and you buy down the rate 2 points, that may cost you, 2%. What I mean, 2%. So you get it down from 7 to 4.99 or something like that. It's going to cost you roughly 4 points right now, is what the builders are charging, what the lenders are charging to buy down the rate to 2%. So 4 points. What we mean by that is the purchase price of the home. A point is 1%. So if the home is $450,000, that's $4,500 times 4 to buy it down 2%. So that'd be $18,000, guys. So you could use, if the builder is giving a $30,000 credit, you can use $18,000 to buy it down 2 points. And just that alone, guys, on $450,000, that's gonna save you around $500 a month, roughly, in my experience and what I've been seeing. So $100,000 in price almost equals buying the rate down 2 points. So you could look at a home that's, $550,000 with no buy down, or $550,000 with a 2-point buy down, and have almost the same payment as a home that's $450,000 with no buy down, that's at 7% interest. If you had a home that's $450,000 with 7% interest, or if you had a home that's $550,000 with 5% interest, guys, you're gonna have almost the same payment, guys. It's not gonna be much of a difference. It's gonna be very, very minimal. So keep that in mind, guys. I hope this helped you out. And 941-879-4730, Robert Lunt, Realty One Group Skyline. Highly experienced real estate agent, guys. Hit the like, hit the subscribe, and I hope I can help you today. Call or text me anytime. And thank you for tuning in, guys. I hope this helped you out a lot.